Welcome to the deep dive. You know, most people, when they think about finance, they think stock markets, right? The big titans. But there's this other giant foreign exchange market, Forex or FX, that, well, it just dwarfs them all. It's huge. We're talking about a daily trading volume exceeding, get this, $7.5 trillion. That's way bigger than all the global stock markets combined. And it's constantly moving, silently reshaping things like, how much your next overseas trip costs or even the price of that imported coffee you had this morning. So today, our mission isn't just to define Forex. We really want to pull back the curtain on this pretty complex world. We'll look at everything from the basics, the mechanics, to some surprising history, and even the psychological side, the hurdles traders face. The goal is to kind of expose the hidden levers of this global powerhouse. We want to distill the really important stuff, the key facts, make you well-informed without, drowning you in information.
Absolutely. And what's fascinating here, I think, is just how interconnected it all is, really. Forex isn't just some abstract financial market. It's fundamentally the backbone of international trade and investment. It makes it all possible. I mean, think about it. Massive companies paying for imports or just individuals sending money home to their families overseas. That's all Forex. Understanding it really illuminates so much about the global economy and how intertwined all our financial lives really are.
Okay, so let's dive into the core then. Let's unpack this. At its simplest, foreign exchange, Forex, it's the market where you swap one currency for another, right, at a specific rate. And foreign trade, well, that's the actual buying and selling of goods and services between countries, exports, imports, all that.
Exactly. And the link between them is incredibly tight. It has to be.
Yeah, like imagine a U.S. company wants to import, say, electronics from China. They can't just pay in dollars, can they?
Nope. They absolutely do exchange those U.S. dollars for Chinese yuan and the price they pay. That's the exchange rate. It's fundamental to that transaction.
So that rate isn't just some number floating around.
Not at all. It has a really significant, tangible impact on foreign trade. And honestly, on a country's whole economic health. Think about it.
Yeah.
If a country's currency gets strong, really strong, it makes their exports more expensive for others to buy. That can definitely hurt export businesses.
Right. But cheaper imports then.
Exactly. Cheaper imports, which might sound good, but it affects the trade balance. Now, conversely, if a currency is weak, it makes exports cheaper, more attractive maybe, but imports become more expensive. So if we connect this to the bigger picture, you can see how a country's economic growth, its competitiveness on the world stage, it's directly tied to its currency's value. It's this constant balancing act.
A real tug of war, yeah. And who's actually in this market? It's not just big banks, is it?
Oh, no, it's incredibly diverse.
Yeah.
You've got individuals, retail traders, maybe like some of our listeners. Then you have businesses, small and large multinational corporations, governments themselves. Central banks play a huge role.
Hedge funds too, right? And institutional investors.
Absolutely. Hedge funds, institutional investors, a big commercial and investment banks, of course. And they're all in it for different reasons. Some are just facilitating trade, making those import-export payments happen. Others are speculating, purely trying to profit from currency movements.
Okay, building on that, governments don't just let these rates float entirely freely all the time, do they? How do they manage them?
Good question. There are basically two main approaches, two systems, fixed and floating exchange rate systems.
Okay, fixed first. What's that?
So in a fixed system, the government, usually through its central bank, actively steps into the market. They buy or sell their own currency to keep it pegged or fixed at a specific rate.
Pegged against what, usually?
Often against a major currency like the US dollar or sometimes a basket of currencies. The big advantage is stability. Businesses know what the exchange rate will be, which reduces uncertainty for trade and investment. It can also potentially help keep inflation lower.
But there must be downsides.
Oh, definitely. The main one is losing monetary policy independence. The central bank can't really adjust interest rates freely to manage the domestic economy if it has to defend the peg.
Ah, right. They're tied to that rate.
Exactly. And they become vulnerable to speculative attacks if traders think the peg isn't sustainable.
Okay, so what's the alternative? Floating.
Right, a floating exchange rate system. Here, the rate is determined primarily by supply and demand in the market. The central bank mostly stays out of it.
So market forces rule?
Pretty much. The big plus is monetary policy independence. The central bank can focus on domestic goals like inflation or unemployment. It also allows for sort of automatic adjustments to economic imbalances. If a country has a big trade deficit, its currency might naturally weaken, making exports cheaper and helping correct it.
But I guess the downside is volatility.
That's the main one, yes. Exchange rates can swing quite a bit, which creates uncertainty. And there's always the potential for rapid currency devaluation if market sentiment turns negative.
Makes sense. So countries are constantly weighing these pros and cons.
They are. And this whole flow of money in and out, it gets tracked, right? Which brings us to what I sometimes call the giant scorecard for a nation's finances.
The balance of payments.
Exactly, the BOP. Think of it like a country's detailed accounting sheet, tracking every single financial transaction between its residents and the rest of the world over a period, usually a quarter or a year.
So everything coming in and going out.
Everything. Money from exports, money spent on imports, foreign investment coming in, investment going abroad, tourism, foreign aid. It's all in there.
Okay, how is it broken down? I know there are different accounts.
Right, there are three main parts. First, the current account. This is probably the one people hear about most. It tracks the trade balance net trade in goods and services. It also includes income earned on foreign investments, minus income paid to foreign investors, and things like unilateral transfers, foreign aid, or remittances sent home by workers abroad.
Okay, trade, investment income, transfers. What else?
Then you have the capital account. This one's usually smaller and deals with things like debt forgiveness or the transfer of assets by migrants. Historically, it also included capital flows, but those are now mainly in the third account.
Which is?
The financial account. This is a big one. It tracks international capital flows like foreign direct investment FDI, like a foreign company building a factory here, and portfolio investments, buying stocks or bonds in another country. It also covers other short-term financial transactions and, crucially, changes in a country's official foreign exchange reserves held by the central bank.
So it uses double entry bookkeeping, right? Credits and debits.
Precisely. Every transaction creates both a credit, an inflow of funds like export earnings, and a debit, an outflow like import payments. In theory, it always balances to zero.
Okay, but this raises an important question. Why does the balance of payments matter so much? Why should you, the listener, care?
Because it's a vital health check for an economy. It gives crucial insights into a country's international trade position. Is it exporting more than importing? It shows how attractive it is for foreign investment. Are funds flowing in or out? And critically, it impacts exchange rate stability. A persistent, large current account deficit, for instance, might signal problems.
Right. It could mean the country is borrowing heavily or selling assets to finance its spending, which might put downward pressure on its currency long term. Let's make this really concrete. Let's talk about India's rupee convertibility. This is a great real-world example. India achieved what's called current account convertibility, or CC, back in 1994. What does that actually mean for people?
It means that for everyday transactions, paying for imports, receiving payment for exports, spending money while traveling abroad, sending money home, the rupee can be freely exchanged for foreign currency and vice versa, generally speaking. It removed a lot of restrictions on those flows.
But, and this is key, India does not have full capital account convertibility, right?
Correct. There are still significant restrictions on the free movement of capital for investment purposes. You can't just freely move unlimited amounts of rupees in and out of India to buy stocks, bonds, or make direct investments without navigating certain regulations.
Why the hesitation? What are the arguments for and against going fully convertible on the capital account?
So the arguments for it are pretty strong. Proponents say it would attract much more foreign investment, potentially boosting economic growth significantly. It would mean deeper integration into the global financial system.
Sounds good. What's the catch?
The catch, and it's a big one, is the risk. Free capital flows mean money can leave just as quickly as it comes in. This increases the risk of exchange rate volatility. Imagine a sudden loss of confidence capital could flood out, crashing the rupee.
Financial instability.
Exactly. Financial instability is the main concern. The Reserve Bank of India has been very cautious, preferring a gradual approach, managing this delicate balance between attracting investment and maintaining stability.
So for you, listening, whether you invest in India or just follow its economy, these policy choices about convertibility have real, tangible effects on risk and opportunity. Okay, so we understand the systems, the tracking, but what actually makes these currencies move day to day, hour to hour? Let's get into some of the economic theories trying to explain this.
Right, the forces behind the fluctuations. There are a few key theories, though none perfectly predict short-term movements. They offer frameworks.
Let's start with one that sounds a bit complex, the International Fisher Effect, or IFE.
Yeah, the IFE. The core idea is maybe somewhat counterintuitively, that differences in nominal interest rates between two countries should reflect the expected change in their exchange rates.
Okay, break that down. Higher interest rate means stronger currency.
Not exactly, according to IFE. It suggests that if country A offers a much higher interest rate than country B, investors might initially buy country A's currency, pushing it up. But the theory says that higher interest rate is likely linked to higher expected inflation. So the currency is actually expected to depreciate over time to offset that interest rate advantage.
So the exchange rate move cancels out the higher interest yield in the long run.
That's the theoretical idea. For example, if the U.S. interest rate is 6% and the Eurozone rate is 3%, IFE suggests the dollar is expected to depreciate by about 3% against the euro over the year. It's about expectations.
Interesting. Okay, what about purchasing power parity, or PPP? That one sounds more intuitive.
It is, conceptually. PPP suggests that, in the long run, exchange rates should adjust so that an identical basket of goods and services costs roughly the same in different countries when measured in a common currency.
The classic Big Mac example, right?
Exactly. The famous Big Mac index from The Economist uses this. If a Big Mac costs, say, $5 in the U.S. and $5 in the Eurozone, Python would imply that the exchange rate should ideally be $1 is $1 to equalize the price.
So if the actual rate is, say, €1 is $1.10, the euro is overvalued according to PPP.
Precisely. Or the dollar's undervalued. PPP is useful for comparing living standards and thinking about long-term currency valuation, but again, it doesn't hold well in the short term due to trade barriers, transportation costs, taxes, and non-traded goods.
So useful concepts, but not crystal balls for trading tomorrow.
Definitely not crystal balls.
Yeah.
But they help understand the underlying economic pressures. Now, to really trade or even just follow the market closely, you absolutely need to know the specific language, the terminology. This is where it gets really practical.
Okay, let's talk terms. First up, currency pairs.
Right. Currencies are always traded in pairs. You're always buying one currency while simultaneously selling another. Think USD or USD-JPY. The first currency listed, like UAR and USD, is the base currency. The second, USD, is the quote or counter currency. The exchange rate tells you how much of the quote currency you need to buy 1 unit of the base currency.
And there are different types of pairs, major, minor.
Yes, major pairs are the most traded. They always involve the US dollar, USD, GBP, USD, USD, JPY, etc. They're very liquid. Minor pairs, or crosses, involve 2 major currencies other than the USD, like Euro GBP or USD-JPY, still quite liquid. Then you have exotic pairs. These pair a major currency with one from emerging market, like USD Air, Turkish Lira, or Eurozar, South African Rand. These are typically less liquid, have wider spreads, and can be much more volatile, higher risk.
Got it. Okay, next term, PIP. I hear this all the time. What is a PIP?
A PIP stands for percentage in point, or price interest point. It's basically the smallest standard unit of price movement in an exchange rate. Think of it like a point in stock prices, but much smaller. For most pairs, like USD-SD, a PIP is the 4th decimal place, so 0.0001. If the price moves from 1.1050 to 1.1051, that's a 1 pip move.
4th decimal, except for the yen, right?
Exactly. The Japanese yen pairs are the main exception. For pairs like USD-JPY, a pip is the 2nd decimal place, 0.01. So a move from 110.45 to 110.46 is 1 pip.
And these tiny moves matter because people trade large amounts.
Precisely. Even a 10-pip move on a large trade can mean significant profit or loss. We also now often see fractional pips or pipettes, which are 1/10 of a pip, for even greater precision in pricing.
Okay. When I look at a quote, I always see 2 prices, bid and ask.
Yes, crucial distinction. The bid price is the price at which the broker or dealer is willing to buy the base currency from you in exchange for the quote currency. It's the price you get if you're selling. The ask price, or offer price, is the price at which they are willing to sell the base currency to you. It's the price you pay if you're buying. The ask is always slightly higher than the bid.
And the difference between them is the spread.
Exactly. The spread is the difference between the bid and ask prices. Yeah. That's essentially the broker's commission or transaction cost for facilitating the trade. Tighter spreads are better for traders.
Makes sense. Now, lots. How does volume work?
Lots standardize the trade size. Instead of saying, I want to trade 53,800 euros, you trade in standard units called lots. A standard lot is 100,000 units of the base currency. A mini lot is 10,000 units, and a micro lot is 1,000 units.
And the value of a pip depends on the lot size.
Correct. For a standard lot of EUR/USD, 1 pip is typically worth $10. For a mini lot, it's $1. For a micro lot, it's $0.10. This lets traders manage their risk exposure based on their account size.
Which leads us nicely to leverage and margin. These seem both powerful and dangerous.
They absolutely are. Leverage lets you control a large position size with a relatively small amount of capital. Your broker essentially lends you the rest. For example, 100.1 leverage means for every $1 of your own money, you can control $100 in the market.
So you can potentially make much larger profits.
Yes, but, and this is the critical part, it magnifies potential losses just as much. A small market move against you can wipe out your initial deposit quickly. Leverage is a double-edged sword.
And margin is the capital you need to put up.
Right. Margin is the amount of your own capital required by the broker to open and maintain a leveraged position. It's like a good faith deposit. It's not a fee, but it's held by the broker while the trade is open. If the market moves against you and your account equity drops below a certain level, the maintenance margin, you'll face a margin call.
Which means you need to deposit more funds or the broker closes your position.
Exactly. So this really raises that important question. How do you manage all that amplified risk that comes with leverage?
Right. And related to direction, long versus short positions.
Simple concepts. Going long means you buy a currency pair, expecting the base currency to strengthen or the, quote, currency to weaken, so the overall value goes up. You buy low, hoping to sell high. Going short means you sell a currency pair, expecting the base currency to weaken or the, quote, currency to strengthen, so the value goes down. You sell high, hoping to buy back low.
And to manage that risk automatically, we have stop loss and take profit orders.
Essential tools. A stop loss order is an instruction to your broker to automatically close your position if the price reaches a certain predetermined level, limiting your potential loss on that trade. A take profit order is the opposite. It automatically closes your position when the price reaches a certain profit target, locking in your gains. These help remove emotion from the closing decision.
Okay, one last term here. Authorized money changers. Are they part of the big Forex market?
Not directly in the sense of setting the overall rates, no. Authorized money changers are licensed businesses, like you see at airports or in city centers, that physically exchange currencies for the public tourists, individuals. They operate using the prevailing market rates, but add their own spread or fees. They're users of the market, not market makers on a large scale.
Got it. So that's the language. Now, let's step back and look at the market's evolution. It hasn't always been this accessible, has it?
No, absolutely not. The history is quite fascinating. In the 19th century, Forex was really an exclusive club. Just major banks, governments, big multinational corporations, very little transparency or access for others.
So what changed? When did it start opening up?
The really big shift started in the 1970s with the collapse of the Bretton Woods system. That ended the fixed exchange rates tied to gold and ushered in the era of free-floating currencies we mostly have today. That created the need for a much more active market.
And then technology kicked in.
Massively. The 1980s brought the first computer-based trading systems, making things faster and more efficient, but still largely institutional. The 1990s, though, that was the revolution for accessibility. The rise of the internet, electronic trading platforms, and electronic communication networks, ECNs, suddenly opened the door for retail traders, individuals like you, to participate directly.
So the internet democratized Forex.
In a huge way.
Yeah.
Then the 2000s cemented its 24-hour nature as trading followed the sun around the globe. We also saw the rise of algorithmic trading, high-frequency trading, machines doing deals in fractions of a second.
Wow. And the 2010s.
That was the mobile explosion. Trading apps on your smartphone put the market literally in your pocket. Social trading platforms also emerged where people could share ideas or even copy trades.
And now, in the 2020s?
We're seeing even more tech integration. Blockchain is enabling crypto to fiat currency pairs, adding a whole new dimension. And AI, machine learning. They're being used for increasingly sophisticated data analysis and trying to predict price movements. It's constantly evolving.
It really is incredible. And you mentioned it's decentralized in 245. Let's just quickly recap that.
All right. Decentralized means there's no single central exchange like the New York Stock Exchange. It's an electronic network connecting banks, brokers, institutions, and traders globally. And 245 means it operates continuously from Sunday evening, when Sydney opens, right through to Friday afternoon when New York closes. Trading just passes from one major financial center to the next. Sydney, then Tokyo, then London, then New York.
So the market itself never sleeps during the week.
Exactly. Which offers flexibility, but also means things can happen while you are asleep. Now, within this massive market, there are different ways contracts are structured, different types of Forex markets, based mainly on when the deal settles. This distinction matters for you, depending on your goals.
Okay, what are the main types?
First, and most common for retail traders, is the Forex spot market. Here, currencies are bought and sold for immediate delivery or on the spot. Settlement usually happens very quickly, typically within 2 business days, T+2. People use the spot market mainly to profit from short-term price fluctuations.
Okay, spot means immediate-ish. What else?
Then you have the Forex forward market. These are private, over-the-counter OTC contracts between two parties, say, a bank and a corporation. They agree today to exchange a specific amount of currency at a specific future date, at a rate agreed upon today. It's customized.
So it locks in a future rate. Hedging, maybe.
Exactly. Forwards are often used for hedging currency risk on future transactions. But because they're private contracts, they carry counterparty risk, the risk that the other side might default.
Got it. And the third type, futures.
Yes, the Forex futures market. These are similar to forwards in that they're contracts for future delivery, but they are highly standardized in terms of contract size and delivery dates. Crucially, futures are traded on regulated exchanges, not OTC. This makes them more transparent and reduces counterparty risk because the exchange clearinghouse guarantees the trade. They often involve leverage and margin.
So spot for quick trades, forwards for custom hedges, futures for standardized exchange-traded future positions.
That's a good summary. Why these distinctions matter for you really depends on whether you're speculating short-term, hedging a specific business risk, or taking a longer-term view via standardized contracts. Different tools for different jobs.
Now, you mentioned regulated exchanges for futures, but the spot market is decentralized. Is it the Wild West? Is there any regulation?
That's a common misconception. While decentralized, it's definitely not unregulated. Reputable brokers operating in major jurisdictions are overseen by regulatory bodies. Think of the CFTC, Commodity Futures Trading Commission, in the U.S., the FCA, Financial Conduct Authority, in the U.K., ASIC in Australia, and so on. Their job is to supervise brokers, ensure fair practices, protect client funds, and prevent fraud. Choosing a well-regulated broker is absolutely crucial for your protection.
Okay, that's reassuring. And one huge advantage often cited for Forex is its liquidity. Why is that such a big deal?
Liquidity is massive. Because trillions are traded daily, it means there are almost always buyers and sellers available for major currency pairs. This high liquidity leads directly to several benefits for you. First, lower spreads. More competition means tighter bid-ask spreads, reducing your trading costs. Second, faster order execution. Your trades are more likely to get filled quickly and at the price you expect, minimizing that annoying slippage.
Slippage being when the price moves slightly between when you click buy and when the trade actually executes.
Exactly. High liquidity reduces that risk, and overall high liquidity contributes to market stability. Prices tend to move more smoothly, without the huge, sudden gaps you might see in less liquid markets.
Right. Liquidity equals efficiency and lower costs, basically. Okay, we've covered a lot of ground on how it works. Now let's pivot to something absolutely critical, risk management. Because, let's be honest, Forex trading involves risk.
Acknowledging and managing risk is paramount. It's not about avoiding risk entirely, that's impossible, but understanding and controlling it.
So what are the main risks we need to recap?
Well, the most obvious is exchange rate fluctuations. Prices are constantly moving, and sometimes sharply. That's the market risk. Then, as we discussed, leverage. It magnifies gains, but also losses. Misusing leverage is probably the single biggest reason retail traders lose money.
Liquidity risk, too, you mentioned.
Yes, liquidity risk. While majors are liquid, if you trade exotic pairs or during off-peak hours, you might find it harder to enter or exit positions quickly at a good price. There's counterparty risk, mainly with OTC derivatives like forwards, though less so with regulated brokers in spot or exchange-traded futures. And finally, the dreaded margin call, requiring more funds if your leveraged position goes significantly against you.
Okay, so facing these risks, what can traders actually do? What are the key strategies?
Several practical tools and approaches. We mentioned stop-loss orders, absolutely essential for predefining your maximum acceptable loss on any single trade. Take profit orders help lock in gains systematically. Position sizing is huge, never risking too large a percentage of your trading capital on a single trade, regardless of how confident you feel.
Diversification, does that work in Forex?
To some extent, yes. Spreading trades across different currency pairs that aren't perfectly correlated can help smooth out returns. But currencies can often move together based on major global events. And then there's hedging, which is a whole topic in itself, especially for businesses.
Right. Let's talk about hedging. How do businesses and even individuals protect themselves from unwanted currency moves?
What's fascinating here is the range of tools. We can broadly divide them into external hedges and internal hedges. External hedges use financial instruments from outside markets. We talked about forward contracts, locking in a future exchange rate. Businesses can also use futures contracts or options contracts.
Give me an example.
Okay, imagine a U.S. company exporting goods to Germany and expecting to receive $1 million in 3 months. They're worried the euro might weaken against the dollar by then, reducing their USD profit. They could use an external hedge, enter into a 3-month forward contract to sell $1 million at a specific rate agreed today, say $1.10 per euro. Now they've locked in receiving $1.1 million, regardless of where the spot rate goes. They've eliminated the exchange rate risk.
Okay, that makes sense. What about internal hedges?
Internal hedges are managed within the company's own operations without using external financial products. They're often about structuring transactions smartly. One technique is netting. If a company owes money in euros to one supplier, but is also due to receive euros from a customer, they can offset those amounts internally, reducing the need for external conversion and the associated risk.
Clever. What else?
There's leading and lagging payments. If you expect a currency you need to pay in to strengthen, you might lead by paying early. If you expect a currency you're due to receive to strengthen, you might try to lag or delay receiving it. Requires good forecasting, though.
Tricky.
It is. Another is match invoicing, simply trying to invoice customers in the same currency that you have to pay your suppliers in. If you pay suppliers in USD, try to invoice customers in USD. Avoid conversion altogether.
So internal hedges are about managing cash flows and invoicing smartly.
Exactly. If we connect this to the big picture, it shows risk management isn't just stop losses for traders. It's a core strategic function for any global business. Institutions also use sophisticated tools like value at risk or VAR. This is a statistical measure. It estimates the potential maximum loss a portfolio might face over a specific time period at a certain confidence level based on historical data. It helps quantify downside risk.
Okay, so we have the technical tools, the strategies, but there's another huge piece to this puzzle, isn't there? The human element. Let's unpack this. Successful trading seems to be about so much more than just charts and theories. It's deeply about trading psychology and mastering your own emotions.
Absolutely critical. You could have the best strategy in the world, but if your emotions run rampant, you're likely to fail.
What are the common emotional struggles traders face? Fear and greed seem to be the big ones.
Fear and greed are classic culprits. Fear can make you hesitate, miss opportunities, or panic and close winning trades too early. Greed can make you overtrade, take excessive risks, or hold on to winning trades for too long, only to see them reverse. These emotions cause traders to deviate from their plan, maybe ignore their risk tolerance, trade pairs they don't understand, or, crucially, fail to use those stop losses because they hope the market will turn around.
And there are specific psychological traps too, right? Things we fall into without realizing.
Definitely. Overconfidence is a big one. After a string of wins, traders feel invincible and start taking bigger, riskier trades, often leading to a major loss.
I can see that happening. What about losing?
That brings in loss aversion. Psychologically, losses hurt more than equivalent gains feel good. This makes traders desperate to avoid realizing a loss, so they hold on to losing positions hoping they'll recover, often letting small losses turn into huge ones. Cutting losses quickly is vital, but emotionally hard.
And confirmation bias, how does that play out?
Confirmation bias means you unconsciously seek out information that confirms your existing belief or trade idea, while ignoring or downplaying evidence that contradicts it. You only see what you want to see, which can reinforce bad decisions.
Wow. So facing all that, how do you actually build the emotional resilience needed? This raises the really important question. How do you keep your head when the market is going crazy?
It's not easy. It takes conscious effort and practice. A clear, detailed trading plan is the absolute foundation. Write it down. Your strategy, entry-exit rules, risk management rules. Stick to it. It externalizes the decision-making, reducing emotional interference in the moment.
So the plan is your anchor.
It is. Then, develop emotional resilience and self-discipline. Practical techniques can help. Some find meditation or mindfulness useful for staying calm. Rigorously avoid impulse trades. Always implement your risk management rules non-negotiable. Regularly review your plan and your performance objectively.
A trading journal helps there, right?
Hugely. Keep a trading journal. Don't just record the trades, record your reasons for taking them and your emotional state at the time. This helps identify patterns in your behavior, especially emotional mistakes. Successful traders learn to acknowledge wins and losses objectively. Neither defines them. Both offer lessons. Learn from both.
And for beginners?
I cannot stress this enough. Start with a risk-free demo account. Practice your strategy, learn the platform, and critically, practice your emotional control without risking real money. Get used to seeing trades go against you and sticking to your plan before you put capital on the line.
That seems like incredibly solid advice. Okay, so what does this all mean? Let's try to bring it all together. We've taken a really deep dive today into this incredibly complex, dynamic, always changing world of Forex. We went from the basic definitions, the surprising ways the market opened up historically, right through to the nuts and bolts of trading terminology, and just now, the absolutely critical role of risk management and psychology.
Exactly. And I think the key takeaway is that while Forex offers immense opportunities, it demands understanding and respect. Success isn't just about predicting the market, which is incredibly difficult. It's about understanding the intricacies we discussed, coupled with unwavering discipline and emotional control. Knowledge is most valuable when it's truly understood and applied. And in Forex, perhaps more than anywhere, it's about continuously learning, adapting, and staying humble in this constant global dance of currencies.
So a final thought for you, our listener, to chew on. As you go about your day, just consider how these massive, invisible global currency flows measured in tiny pips, managed with complex strategies and human emotions, are constantly, silently influencing things way beyond big bank balance sheets. They touch the price of your groceries, the value of your investments, the cost of your travel. It's this constant, invisible dance of economic power shaping our world, and now, hopefully, you have a much deeper insight into how it all works.